If you choose to engage in active trading as opposed to hodling, you will likely need to employ more than market orders. A stop limit order offers more customization and control. Beginners may find the notion complicated, so let's examine the fundamental distinctions between limit, stop loss, and stop limit orders. Limit order versus stop loss order versus stop limit order. Limit orders, stop loss orders, and stop limit orders are among the most frequently used order types. Stop limit orders combine characteristics of stop loss orders and limit orders. Limit orders allow you to establish a range of acceptable prices, while stop loss orders set a stop price that triggers a market order. Let's go deeper. Limit order. When placing a limit order, you specify either a maximum buying price or a minimum selling price. When the market price hits or exceeds your limit price, your exchange will immediately try to fill the limit order. When you have a target entry or exit price and are willing to wait for the market to match your requirements, these orders are beneficial. Traders often put purchase limit orders below the current market price and sell limit orders above the current market price. If you put a limit order at the current market price, it will most certainly be executed within a few seconds, unless the market is illiquid. For instance, if the current market price of Bitcoin is $32,000 BUSD, you may create a buy limit order at $31,000 to acquire BTC if the price falls below $31,000. You may also put a sell limit order at $33,000, which would cause the exchange to sell your BTC if the price rises over $33,000. Stop limit order. A stop limit order combines a stop trigger with a limit order, as previously stated. The stop order provides the exchange with a price at which to place your limit order. Let's see how it works. How does a stop limit order work? The easiest way to comprehend a stop limit order is to disassemble it. The stop price serves as the trigger for a limit order. When the market hits the stop price, a limit order with a specific price is instantly created, limit price. The stop and limit prices may be same, although this is not required. In reality, it is safer to put the stop price, trigger price, for sell orders somewhat above the limit price. For purchase orders, the stop price might be placed a little below the maximum price. This enhances the likelihood that your limit order will be filled once it has triggered. Purchase and sale stop limit order examples. Buy stop limit. Imagine that BNB is now trading at $300 BUSD, and that you want to purchase when it begins a positive trend. However, you don't want to overpay for the BNB if it continues to climb rapidly, therefore you must set a maximum price. Suppose your technical analysis indicates that an upswing may commence if the market closes over $310. You decide to initiate a trade using a buy-stop limit order in case the breakout occurs. You establish a stop price of $310 and a limit price of $315. As soon as BNB exceeds $310, a limit order is placed to purchase BNB at $315. Your purchase may be fulfilled at a price of $315 or less. Note that $315 is your maximum price, so if the market rises over it too soon, your order may not be totally completed. Sell stop limit. Imagine you purchased BNB for $285 BUSD, and the current price is $300. In order to protect losses, you decide to utilize a stop limit order to sell BNB if the price returns to your entry point. You set a stop price of $289 and a limit price of $285 on a sell stop limit order, the price you purchased BNB at. If the price hits $289, a limit order will be issued to sell BNB at $285. Your purchase may be fulfilled at a price of $285 or more. How can you put a Binance stop limit order? Suppose you recently purchased 5 BTC for $31,820.50 BUSD, because you anticipate a price increase. Please be aware that the stop limit order will only be executed if and when the stop price is achieved. This indicates that the limit order will only be executed if the market price meets or exceeds your limit price. The limit order will stay open if it is activated by the stop price, but the market price does not reach or exceed the price you specified. Occasionally, you may find yourself in a circumstance where the price falls too quickly and your stop limit order is not executed. In this situation, you may need to use market orders to rapidly exit the deal. The benefits of using a stop limit order. A stop limit order enables you to tailor and organize your transactions. We cannot constantly monitor prices, particularly in the 24-hour crypto market. Another benefit of a stop limit order is that it allows you to select an appropriate profit target. Without a cap, your order would be fulfilled at the current market price. Some investors would rather hold than sell at any cost. Negative aspects of stop limit orders. Stop limit orders have the same drawbacks as limit orders, namely that there is no assurance they will be executed. A limit order will only begin to be executed at the stated price or above. This price, however, may never be fulfilled. Despite the fact that you may construct a space between your limit and stop prices, the space may not always be sufficient. Highly volatile assets might exceed the spread you choose when placing an order. Liquidity might also be an issue if there are insufficient buyers to satisfy your order. Consider using fill or kill if you're concerned about orders not being completely filled. This option states that your order will only be executed if it can be entirely filled. However, the more criteria you put to your order, the less probable it is that it will execute. Strategies for placing limit stop orders. How should stop limit orders be used now that we've examined them? Here are some fundamental trading tactics that enhance the efficacy of your stop limit orders and mitigate some of its downsides. Consider the asset's volatility before setting a stop limit order. We have previously suggested having a slight spread between the stop order and limit order to maximize the likelihood that your limit order will be executed. Nonetheless, if the asset you are trading is volatile, you may need to increase your spread. Consider the liquid nature of the asset you are trading. Stop limit orders are especially advantageous when trading assets with a substantial bid-ask spread or limited liquidity, to avoid unwanted prices caused by slippage. Utilize technical analysis to establish price ranges. Setting your stop price at an asset's support or resistance level is prudent. Technical analysis is one approach to determining these levels. To capitalize on a breakout, you may, for instance, employ a buy-stop limit order with a stop price slightly above an important resistance level, or a sell-stop limit order right below a support level to ensure you are out of the market before it continues to decline. Final thoughts. A stop limit order is a potent instrument that may give you with more trading capabilities than standard market orders. In addition, it is not necessary to be actively trading for the order to be executed. By combining numerous stop limit orders, it is simple to manage your holdings regardless of price movement. Thank you for watching.